Hi there, welcome to Kneppy Invest. It is October 1st as I record this, which means I need to do my monthly portfolio performance update, which makes it 15 months since I started this exercise. And in this series of videos, I am tracking the performance of three portfolios. And the aim is to track these portfolios over a 5-year period just to see how different strategies might work. And the three portfolios I am tracking are a group portfolio, and this consists of companies that viewers of this channel selected. And the question I gave viewers of this channel was, give me three companies you think will outperform the market over the next 5 years. So I collated the results, came up with a group portfolio, and the whole point of this portfolio is it's completely passive. No buying, no selling out of this portfolio for 5 years. Now, one little thing I really didn't consider at that point in time was with dividends, the cash on hand will grow. And not only that, there is one company that was taken out. That was Unity. So that means we have extra money that's just lying there doing nothing. But the whole point of this exercise is just to see how a completely 100% passive strategy can perform over a 5-year period. And the other two portfolios I am tracking are personal portfolios that are using different strategies. The first strategy is a long-term buy and hold. So find companies that I want to hold for the long term that I think can outperform the market. Now, that strategy has slightly changed over the past few months, and now I'm more looking for high quality companies. And in that portfolio, in the past, I've included low quality companies. So I want to sort of subtly change that strategy to only include high quality companies. And you've probably seen, if you've been watching my videos, you've probably seen my definition of high quality and what it means. For instance, increasing revenue through time. I prefer profitable companies, those sort of things. So I am slowly changing the makeup of that portfolio, and you'll be able to see, and I'll show you some of the changes I have made in the past month. And the second personal portfolio I am tracking using a short-term sentiment and momentum strategy. And at this point in time, I'm highly in cash in that strategy or that portfolio, and it is by far the best performing portfolio out of these three. So it does seem like in these stressful times, these bear market times, sentiment and momentum strategy is performing best. And maybe that is the best sort of investing strategy we can use during these bear market times. Before we have a look at the performance of the portfolios, the first thing I like to do in these videos is have a look at the XGO monthly chart. And the reason I'm doing a monthly chart here is because I do these videos every single month. And I've decided to go back to 2006. And the reason I'm looking at the last 16 years is because I wanted to include the GFC in this chart because I think it's quite important, particularly where we saw the bottom of the XGO in March 2009. And the reason it's important is because we saw the XGO bounce off a really strong, powerful support level, which is portrayed by that sloping darker line. That's the long-term trend in the XJO. It goes back to 1980. And ever since 1980, whenever the XGO hits that long-term trend, we see it bounce off it. It happened during the bottom of the GFC in March 2009. It happened about 2 or 3 times previous to this. And it also happened during the COVID-19 financial panic. It bounced off the long-term trend at 4,400. And there was a long tail on that monthly chart, which would have been March 2020. Now, the two sloping orange lines is a trading range that the XGO has been trading in since 2009. And that's a fairly strong trading range because only once has the XGO broken the trading range, and that was during the COVID-19 financial panic. Now, you could argue it slightly, or for a very short period of time, it broke the trading range to the upside after the XGO went up for about something like 11 months in a row, maybe not that many, but that would have been in September, August 2021. We saw the XGO briefly go above the top of the range, but there was a little bit of selling came in, and that was the top of the market back in August 2021, and there's actually a triple top. If you look at the weekly or daily XGO over the past 2 years, there is a triple top at around about 7,600. But the most important thing is, whenever the XJO gets to the bottom of the range, we see some buying coming in. So that bottom of that range is a fairly strong support level. And right now, the XGO is moving towards that bottom of the range. The bottom of the range right now is around about 6,200, and the XGO is just above 6,400. If I see the XGO hit the bottom of the range, that could trigger me to take more positions in high quality companies. Right now, even though I am buying companies, I'm also selling companies. So I'm not really adding to my portfolio in terms of less cash. I'm just waiting for some sort of signal to increase my positions in companies that I do like. And one of those signals would be the XGO reaching the bottom of the trading range. It could happen next week, it could happen in a few months, or it might not happen at all. A few times we've seen in the past 13 years, the XGO gets close to the bottom of the trading range, and then we see it bounce off it. So it doesn't mean it will hit it. It just means it's a better, there's less risk at these levels than it would be when the XGO is at the top of the trading range. Before we have a look at the performance of the group portfolio up until the end of September, let's have a look to see where the group portfolio stood at the end of August, and just want to see how the group portfolio has performed over the past month. So 1 month ago, the group portfolio was down 15.7%, which takes into account capital losses of $17,907 and dividends of $2,256. By far, the best performing company at this point in time was Lake Resources, and it seems like the best performing company in the group portfolio has been Lake Resources for the past 12 to 13 months. So let's have a look to see how the group portfolio is now standing. Maybe the group portfolio has outperformed the market, and maybe the group portfolio was up in September. Unfortunately, the group portfolio was not up in September. In fact, it has lost ground, significant ground. Now it's down almost $22,000. We have received a little bit of dividends in the past month. Still, the best performing company is Lake Resources, but the share price of that company has fallen away. Second best is BrainChip. Then also the third best is Unity Group. So no change at the top and really no change at the bottom. But Email Payments is now the first company that is down over $3,000, and only 6 companies in the black to the end of September. And the 3 other companies, apart from the first 3 I've already mentioned, are ResMed, CSL, and BHP Group. And the main reason why CSL and BHP Group, particularly BHP, are in the black now are because of dividends. In fact, BHP capital gain loss, 824, but dividends of 860, which means overall return over the past 15 months is $36.63. So this is going the way I thought it would go in a bear market. I would say that the group portfolio would significantly underperform the market during bear markets, but would significantly outperform the market during bull markets. So we just have to wait for the market to turn. And as soon as it turns, I think the group portfolio will quickly catch up to the market performance and then overtake it after a period of time. And to be honest with you, we've already had proof that the group portfolio outperforms the market when it's going up. In fact, the first about 6 or 7 months, the group portfolio was significantly outperforming the STW. So the STW is the benchmark I'm using. And the reason I'm using the STW as a benchmark is because it includes dividends. For instance, the STW capital gain is down 10.9%, but dividends of 8.14% per annum. So I have analyzed these using ShareSite because eventually over a 5-year period, I want to see the analyzed returns, not the overall returns. But in an analyzed basis, the group portfolio is down 17.96%, while the STW is down 2.54%. So again, the group portfolio is significantly underperforming the STW, but as I mentioned before, and I'll mention it again and again, as soon as the market turns around, that's when we're going to see the group portfolio significantly outperform the STW and quickly catch up to that benchmark. Now to the performance of my own personal portfolios. And the first one here is the long-term buy and hold. So this is a strategy where I look for companies that I think will outperform the market over the long term. Now, historically, I have been more risk-taking, buying companies that are not profitable, but I have the potential to grow significantly in the future. A lot of those companies have not really made it. And to be honest with you, I have traded some of those companies. And you'll be able to see that when I show you a slide maybe the next slide or the slide after, I actually have sold out of quite a few companies in this portfolio. And when I look back, I realized I was just trading them. Some of those companies' share price went up a fair bit over a short period of time, and I decided to take profits. The true sense of a long-term buy and hold is even if the share price increases 100%, you don't sell. You keep on holding them for the long term. That's one of the reasons why I'm changing my strategy to holding more high-quality companies, because over the long term, I expect high-quality companies' share price to keep on increasing. So I'm slowly changing the makeup of this portfolio. And I'll talk about some of the trades I have made over the past month in the next slide. At this point in time, the best performing company in this portfolio is BrainChip. I don't consider BrainChip to be a high quality company. So that BrainChip belongs in my short-term portfolio, not in this long-term portfolio. Second best performing company is Base Resources, a mining company. In my opinion, mining companies are low quality companies. Now, the reason why I might keep Base Resources in this portfolio is because of the dividends. So capital losses of $105 for Base Resources, but dividends of $700. Third best performing company is Fiducian. That is a high quality company, in my opinion. That belongs in this portfolio. Then we've got Ansarada, a little bit iffy on that company as being a high quality company. You've got X-Tech. That's probably a low quality company, but it has a lot of potential. And so that might belong in the other portfolio, but it might belong in here. Maybe it's more of a speculative play. Sequoia Financial, I think that company is heading towards being a higher quality company. CSL, AFT Pharmaceuticals. I bought my first ETF, Qual, Q-U-A-L, Quality. That's one of the reasons I did buy that ETF. Ballydor Technologies, Enero, JB Hi-Fi, Breville, Aristocrat Leisure, Goodman Group, AVA Risk. As we move down towards the bottom of this portfolio to the worst performance, most of the worst performing companies in this portfolio are low quality companies. Zip, Electro Optics, Cydev, Kogan. Well, Kogan I still think is a low quality company. They still have to prove me they are high quality. Nanosonics, I think could be a high quality company, but just not there yet. Orbital Corp, Dell Financial Group, Pointera, Gentrack, Clinical Pharmaceuticals, I believe is moving towards being a really high quality company. And in fact, I have bought more shares in that company because I think Clinical is pretty much undervalued right now. Spectre, XREF, Superloop, Playside, Energy One is moving towards being a high quality company. So the majority of companies that are the worst performers in this portfolio are low quality companies, and those are the sort of companies I want to sell out and then bring in some of the high quality companies into this portfolio. I've also taken a position in an American company, PayPal, so that's on the NASDAQ. I've also bought into two more American companies. Now, those purchases have not gone through my super fund just yet. Those two companies are Amazon and Alphabet. So I bought those yesterday. And the reason I bought those two companies is because of valuation. Right now, I do think Alphabet is looking like really good value. That's the reason I took a position in PayPal about 3 or 4 months ago, because the value looks pretty good and PayPal is up right now. So overall, you look at the capital gains for PayPal down $427, but currency, because Australian dollar has gone down compared to the US, currency gains of $549, which means my overall return for PayPal right now is $122. So even though the overall market or the NASDAQ is going down because of currency reasons, I'm actually in the red or in the black for PayPal at this point in time. So expect over the next 3 to 6 months a significant change in the makeup of this portfolio. And eventually, hopefully in about 6 to 9 months, I will have the portfolio I want, this portfolio to be full of high quality companies and ETFs. Now onto the purchases and disposals I made in this portfolio over the past month. JB Hi-Fi and Enero are two ASX companies I bought. I had price targets for both those companies. JB Hi-Fi, the price target was 40. If it fell below 40, I was going to take a position. Enero, if the price of that company fell below 3, I was going to take a position. And the other purchase I made was Qual, the ETF. And I looked at the Qual, how they define quality companies, and I like the definition. So I decided to buy my very first ETF. And the 3 disposals I made closed loop. I think that has a potential to become high quality, maybe in 2 or 3 years down the road. But at this point in time, I think that company more belongs in the short term sentiment and trend portfolio. Sold out of Connection, and I've also sold out of MCS Services. I've held that company for about 5 or 6 years now, and I decided to take profits. So overall, my cash on hand has fallen from $12,677 to $9,738. I've also acquired those two American companies, Amazon and Alphabet. So my cash on hand after those two purchases is now down to just above $1,000. A few months ago, I realized that I needed to change my investing philosophy when it comes to my long-term portfolio. And the reason behind that is because I've gone part-time in my work, and going part-time means I've really got to focus on high quality companies. So when I was a risk-taking investor, what I was doing was I was looking for a basket of really high risk companies, small companies on the ASX. And the hope was, and the philosophy was, that a few of those companies would make it in the long run, would become 10 baggers. 100 baggers would be the ultimate dream. And that was of the knowledge that the majority of the companies in that basket would absolutely fail. So that was my philosophy as being a risk-taking investor. Now, I've changed my philosophy because I've gone part-time. I'm more of a risk-averse investor. And the other reason is when you take a look at the 10 best performing companies in my long-term portfolio, all of these companies I've either taken full profits or partial profits in. And really, when you look at all the trades I've made, taking profits, that's actually going against my initial philosophy, if you understand that. So Beam Communications, I saw the share price of that company run up and I decided to take profits. Revison, I saw the share price of that company run up and I decided to take profits. Same thing with Alexium, same thing with EnviroSuite, same thing with Ambertech, same thing with Aussie Broadband. So my initial philosophy was to hold a basket of these companies for the long term on the hope a few of them will make it. But I was taking profits when the companies, and these are low quality companies, share price took off. Now, this has been beneficial for me because the overall market has turned down and a lot of these companies' share price have fallen a significant amount. For instance, Revison, I took profits at that company around about 85 or 90 cents. Share price now is 12 cents. Even Aussie Broadband, and Aussie Broadband, I think, has the potential to be a high quality company in the next 3 or 4 years. Share price of that company has fallen from $5, even above $5, to $2.28. So I was not really following my initial philosophy. And that's another reason why I've decided to change my philosophy. And now I'm focusing on high quality companies. So over the next 6 to 9 months, I hope to completely overhaul my long-term portfolio and only hold high quality companies and high quality ETFs. Now to the performance of the long-term portfolio, and just like the group portfolio, I expect the long-term portfolio to underperform the market during bear market times, and outperform the market during bull markets. That's exactly what happened for the first 6 or 7 months of financial year 21. The long-term portfolio significantly outperformed the market at one point in time. But as soon as the market started to changing, the long-term portfolio started to perform significantly worse than the STW. So as soon as the market starts to turn around, I fully expect this long-term portfolio, particularly because I will be owning high-quality companies, and high-quality companies will outperform the STW. Because what I'm doing with a portfolio and owning high-quality companies, I take the ASX 200 and I get rid of all the low-quality companies. I consider banks to be low-quality companies. I consider mining companies to be low-quality companies. And if I'm just holding high-quality companies, that alone should outperform the overall market. Now to my personal short-term sentiment and momentum. And in fact, you probably could call this medium-term or even long-term sentiment and momentum, because the ultimate goal is to own companies in this portfolio for a very long time. And if I own them for a very long time, that means the share price keeps on going up and up, and there's no reason to sell out. That's the ultimate dream, to have a 10 bagger, a 100 bagger in this portfolio. So at this point in time, I have sold out quite a few companies, and right now I only own about 10 companies within this portfolio. And you'll notice the majority of the companies in this portfolio are in the black, so I have made profits. So the whole point of this portfolio is to ride my winners as long as possible and sell out of your losers. And I am thinking of selling out of Linus Rare Earths. I want to own that company. I like the potential or future potential of that company, but it's in the red, $769 down. Best performing companies in this portfolio: Neuron Pharmaceuticals. Share price of that company is in a long-term uptrend. IPD Group, recent IPO, but the share price of that company keeps on going up, even though the overall market is going down. Johns Lyndon Group. Now, you could probably argue with me that the share price of that company is not in an uptrend right now, but because I've owned that company for quite a while, the share price is still significantly higher than from when I bought into that company. MMA Offshore, MRM, share price of that company is in an uptrend. NRW Holdings, share price of that company looks like it is moving or possibly moving into an uptrend. Treasury Wine Estates, it looked like that the share price of that company was moving in an uptrend. And a company I was thinking of maybe selling out and taking profits was Ansell, but I've decided not to. The share price of that company has moved up since when I bought in. And when I bought into Ansell, it was at a really strong support level. The other company here is West African Resources. Even though the price of gold is in a downtrend, and I am thinking maybe I should be looking at commodity prices. And if commodity prices are in a downtrend, I should sell out of all the companies that are mining that commodity. So for instance, gold price is in a downtrend right now, so I should not be holding gold companies at this point in time. West African Resources is a gold company, but I'm only down $42 right now. And I think when you look at a lot of gold companies, there's a lot of value in those companies. And I think there is potential that the price of gold will turn around soon. But that is a dangerous thinking because it is in a downtrend, and that downtrend could continue for a while longer. Not very active in this portfolio, only one disposal. That was Comply FinTech. And the reason I sold that company was share price was not moving up or down. And I really wanted to increase my cash levels in this portfolio. So my cash levels now, when I include that disposal and also include $269 of dividends, has increased to $57,179.85. And the whole point of this portfolio using this strategy is to build up my cash levels when you are in a bear market, so you can take advantage of when the market starts to turn around near the bottom of the bear market. You can't time the absolute bottom of the market, but you can time when the market starts to turn around. And when I see signs that the market is turning around, when I see signs that there is positive sentiment coming back into the market, that's when the cash levels in this portfolio will move toward zero. Not seeing those signs just yet, and that's why the cash levels in this portfolio are still increasing. Now to the overall performance of this short-term portfolio using the short-term momentum sentiment strategy. The main thing to take away from, actually there's two main things to take away from this. The short-term portfolio, or this portfolio using this strategy, is outperforming the market and significantly outperforming the other two portfolios. The other thing to look at here is the capital gain differences between the short-term portfolio and the STW. The short-term portfolio is only down 0.33%, while the STW is down 10.9%. And there's a reason behind that. And it all comes back to ride your winners, set out of your losers. So I'm hoping the benefits of this strategy are pretty clear when you compare the capital gains of this strategy to the STW, to the group portfolio, and also to my long-term portfolio. You minimize your capital losses using this strategy. But overall, on a per annum basis, the short-term portfolio is up 2.2%, while the STW is down 2.54%. So overall, this has been and is a successful strategy thus far. Now let's compare the STW to the three portfolios, just looking at the performance. And the only portfolio that is in the green right now is the short-term sentiment, up 2.2%. The two other portfolios, the long-term buy and hold down 5.9%, and the group portfolio down 18%, both comparing unfavorably to the STW, which is only down 2.54%. Now, the last thing I want to say right now is I am not concerned about where we are in the market. Bear markets are unusual. They don't happen all that often. the usual thing for the equity markets to do is to go up. So eventually we will see a shift in sentiment. We will see the market start to turn around. And when that happens, you don't want to be 100% in cash because you won't be able to take advantage of the beginnings of a bull market. And the beginnings of the bull market, to be honest with you, are the best times to be an investor because a lot of times you will see the biggest gains in the equity markets during the start of bull markets. That's all I have for this video, looking at the 15-month performance of the 3 portfolios that I am tracking and comparing it to the STW. If you have any thoughts, any concerns, anything to say whatsoever, just leave in the comment section of this video. Otherwise, I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.